So is this a sign the market rebound has come too far, too fast? Tim, that's the open question.
Well, Dom, so many puns to open with, but and it's great having you 2 days in a row. So what I'll say is, first of all, gold's going to rally. If you're as worried about the Treasury yields as some may be, then you buy gold here, and I think you're buying gold anyway long term. But I'm less concerned about the 10-year where it is. I mean, I think part of this is really truly being reassured that the economy is okay. Having some sense that, yes, I think there's some concern on deficit dynamics in a world where I think this White House is going to start talking about tax cuts. So, I mean, it doesn't surprise me that we are where we are. I think you don't really start talking about the impact on equities from the bond market until you're north of 5%. And I think we have an auction or two ahead of us that would be the place to really start to get worried. This is a snapback. And if I look at the trend from whether I'm going all the way back to July of 2020 or whether I even go back to that CPI kind of blow off top in October of 22, from the peak of inflation to present, the long bond, or at least, the 10 years done almost nothing. So I'm going to say I'd rather see rates here than at 350, which is what I said yesterday, and I think I'll say it like that for a while.
Now, Karen, one of the words I heard a lot more in just the last month or two that I haven't heard a lot of in the last week or two is
I don't know what that word's going to be.
Stagflation.
Okay.
Stagflation. That's the word. I heard it a lot over the last couple of months, but no one's really mentioning it now.
Right.
Yields keep going higher. Is inflation as big of a worry, or is this maybe yields going higher because there is an anticipation of a growth story that's there maybe longer term?
Yeah, I think the latter. I think some of it is the lack of a recession story, which was really starting to be the consensus view after Liberation Day. So I think the odds of that, a lot of houses are taking the odds of that recession down. And I think Tim always talks about rather have a 5% 10-year or 30-year rather in a good market, good economy, than a 3.5% in a weaker economy. But to me, when I look at the cues, the bounce is so extraordinary. And, the VIX, we saw it in the low 50s not that long ago, and now it's 18 and change. To me, I'm lightening up a little. I'm always long, always. That's how I always go. But I have some QQQ put spreads that I put on a couple days ago, lost money in that already. But I think it's a little more prudent to, I don't know, this feels a little toppy.
The VIX is an interesting point. We don't talk about it all that much because it is very kind of idiosyncratic and very inside baseball for professional traders. But it is a gauge of volatility. And it was massively high just 2 to 3 weeks ago. And all of a sudden now, it's like it was before Liberation Day even happened. So if you Rip Van Winkled it and just fell asleep for 3 or 4 weeks, what gives?
And the stat that if you buy you should buy the market when the VIX is above 35. Volume exploded on the lows in the equity market. Tim talks about the 10-year yield. I'd rather it be lower. It's not lower. But let's look at it through this. You said stagflation. Yesterday, we got some relief from inflation, right? With CPI, the lowest increase since February of 2021. Doesn't that give you some hope that the stag inflation is not there right now presently? And if you look at the overall market, if you look at it on a 30-year basis, the dot-com bubble, the market fell 77%. Financial crisis, 57%. The European debt crisis, 22%. Pandemic, 34%. We're always higher. On average, the market increases by 10% a year historically. So if you've missed the 30 best days in the last 30 years, you've given back 83% of your performance. So it's the old, what's the line, Dom? It's not
time. It's not timing the market. It's time in the market. Yep.
So I just it's nice how you guys did that. Could you do that again?
Yeah, it was totally. I knew where he was going to go. He's a master of these cliches. But the point is, I'm not bullish every day. I'm bullish every year. Stay in the market unless you have a daughter that's going to school or a son that's going to school, or you're retiring,
or you need a down payment on the house.
You need a down payment on the house. Set it and forget it, and take these little hiccups. Karen's always long because she's a value investor. She's got to be in the market. I like to play it from the hip. I'm long the market.
All right, so